How's it going? David from Comic Book Investments. So it's Friday, so today's Financial Fridays. This is where I go over just little tips and little advice on just different financial decisions and things like that. So today I'm going to talk about is refinancing your home. And I actually just did mine. Got all these pages here. I just refinanced my home. This is actually the second time I've refinanced my home. I've pretty much done it almost every year and a half. And I'll go into more why I would do something like that and what it all is. So what exactly is a refinance? Well, a refinance is basically a brand new loan on your home. So you go through the same loan process. You know, you have to have a credit score, your tax returns, W-2s, 1099-Ks, whatever it is, and you go to a bank and you basically get a brand new loan on your home. It pays off the old loan. So let's say you're using Chase Bank for your original home loan. Then let's say you go to Bank of America. They basically pay off the Chase Bank, and now you have a brand new loan with the new bank. You no longer use Chase, now you're with Bank of America, so you pay your mortgages to Bank of America. Now, why would someone want to refinance? There's many reasons, but there's two main reasons. One reason could be that someone wants to take cash out. So let's say you've lived in your home and you have a 30-year fixed and you've lived in it for like 10 years. And let's say you've built up, $150,000 in equity. Now you could continue paying off your loan until it goes away and then you own your home outright. Or you could take some money out. A lot of people take money out. Maybe it's for college, for their kids' college fund, or they could do it because they want to remodel their home. They love their home, but they want to put like 50 grand into it. They don't have 50 grand, so they refinance. They take money out and get a new loan. So let's say you have a $300,000 home. You've already paid off 100 grand, so you're at 200,000, and you want to take 50 grand out. You renegotiate the terms. You get another 30-year fixed, or you could be a 20-year or 15-year. And you take out 50 grand and you get a loan against that because the loan is so cheap on a house compared to a personal loan. Personal loan could, be like 10, 20%, while a mortgage on a home is, 2, 3, 4%. So it's better that way. So you take out money, you remodel your home, whatever it is. So you take out cash. Another reason why, the reason why I'm doing it is because interest rates are lower than what I originally got in at. And so now I'm renegotiating the terms and going down to, I got in at 2.375%. So mortgages, like, the reason why they go up and down is they're tied to the government-backed bonds. And the way it works is if the bond prices are going up, then the mortgages rate goes down. I'll show you a graph. So these are the mortgage rates, or the price of a bond. These are the price of the bond. And as you can see, as recently, mortgage rates have been going down. And the reason why is because these have been going up. And this is basically what someone would pay for a bond. And basically what these they're called candlesticks, what they mean is green means that it started the day, if it's green, it started the day at its lowest point, so right here. And then at the end of the day, it moved all the way up here. And if the candlestick has a line, that means that the line, the top of the line, is the highest it ever went throughout the day, and then the bottom is the lowest. And if it's a red candle, that means it started the day here and ended the day down here. So that's how you read candlesticks. But in any case, rates have been going down recently over the past week or so because the bond prices have been going up. So bond prices go up, rates go down. That's how it works. Now, it has to do with what investors are willing to pay for the bonds and all this kind of stuff, and government and all this kind of stuff. I am not an expert on that. There's a million people on YouTube that are way smarter than me. One of the people I listen to is Derek Evans. He's a local realtor around here, and he deals with that kind of stuff all the time. And so he goes into more details about it. I can link his YouTube below. But that's someone that I like to listen to because he has to do with San Diego, where I'm from. So it makes sense. So that's kind of how they work. All right, so if we look over at the way I look at kind of like where rates are at, is I can go to NerdWallet, and this kind of tells me what the average of a 30-year fixed is, 20-year, 15-year, all this kind of stuff. What the average going is. Now, right now, the average is at 2.8. And you can see it come over time. You can see how recently, if you look, it's been dropping. See? Dropping. Now, you can get a 20-year, 15-year, 10-year, a 7-1 ARM, a 5-1 ARM. I would not really recommend these as much because basically it means after like 7 years, your rates change. So it's a more variable rate. Fixed rate is perfect for now because historically these rates have been so low. So low. I mean, I remember my parents talking about in the 80s, they were up to like 14, 15, 16%. You know, it's crazy. But now rates are, in the twos. I locked mine in at 2.375. So mine's below the average. You can also go to bank rate, is what I use to kind of look at different lenders. Lenders is just the bank, meaning, and what kind of rates they're looking at. So, you just fill out these little parameters. And yeah. And then you can circle by lowest rate. So Loan Depot's often 2.25, but you have to pay points. And what paying points means is you pay a percentage of your loan down so you can get a lower rate. That's all that kind of means. The reason why you would want to pay points is if it makes sense. Like, for example, I paid points down, $7,000 in points, so I could get the low rate of 2.375. This one you'd have to pay 9,000 points to get this rate. So that's what you pay points to get a lower rate. And why would you want a lower rate? And why would you want to pay all this upfront cost? Well, it depends how long you're keeping the house. For me, I'm going to keep the house the full 30 years of the loan. So that means every month I'm paying a little less. But over 30 years, that really adds up. I calculated from my previous rate, which was 3.875, to now my 2.375 rate. I'm going to save $80,000 in the term of the 30-year loan. So yeah, paying points makes sense. If you're not, though, if you're only living there, say you plan on 3 to 5 years or something like that, maybe buying points isn't the best option. So you can find options down here where you don't have to pay points, right? You can go down here where it's like, oh, you don't really pay that many points, but you get a 2.675. You can go even lower where they pay you. Look, no upfront costs. But you get a 2.7. And then you can also do it where they pay you, where they actually give you money back a little bit, and incentives and stuff like that. So that's why you would want to pay points. So if you're going to hold the loan for a long time, then you probably want to get the best rate you can. And here's another thing. You can roll the points. So that $12,000 that I showed you or whatever that they had, you don't have to pay that. It's not like you have to come in. You can roll it into the loan. So that's what I did with mine, is I rolled those points into the loan. So technically I don't have to pay up front. And also with refinance, you miss a month of mortgage. So May, I won't have to pay the new bank until actually June. So I get it's kind of like a month off, which is kind of nice. I'm going to use that to fix up some things. But another thing you could do is you can also shop rates. So, for example, Better.com had a really easy user interface that I used, and I got a certain rate with them. And I kind of liked it, and I was moving forward with them. And I was about kind of in the beginning processes, like sending them stuff like that. I then called Loan Depot and I'm like, look, this is the rate I have. It was 2.5, and I had to buy $9,000 worth of points. And they're like, okay, let me see if we can beat that. And so then they beat that, and they gave me the 2.375 with the same $9,000 in points. I was like, okay, so I'm a little less. And then I was like, well, I'm just going to take this and I'm going to try to shop around, see if I can find something a little better. And they'll go, okay, how about this? If you guarantee that you'll use us, we'll drop from 9,000 in points to 7,000 in points and keeping the 2.375. I'm like, okay. And so I went with them. And it was pretty easy. Just send them some stuff and then, a couple calls. Not really much work. But you can shop rates. You can take your loan. You'll get like an estimate in the beginning. You can take that and you go to different banks, different lenders, and you're like, hey, what can you give me a better deal on this home? So that's pretty good to use. I learned that from a friend years ago. So if you look over here at the mortgage, right, mortgagecalculator.org, I like using this one. It's kind of simple. You can just throw in your parameters and you ask yourself, okay, let's say my home value is $300,000, right? How much? And let's say this is if you're buying a new home. You can also make it. We'll just use the numbers for a refi. And let's say I've already built up, or let's just keep it at $300,000. So the loan amount is $300,000. Let's say that your loan that you're trying to get from different banks is $300,000. That's what you need, right? And let's say your rate is currently 3.75. Like that's what I had a year and a half ago. All right, let's get rid of all this numbers because we don't need this for now. So you can calculate here, and your monthly payment is $1,410. So let's remember that $1,410. Now let's see if you get down to 2.5. How much will that change it? Now it's down to $1,185. Whereas the previous one? Let's see, quick math here. Let's see, 1410 minus 1185. You save yourself $225 roughly, and that's how much you're going to save a month if you decide to refi at a lower rate. What if my original loan that I got for this house back in 2018, 6.1. I believe my actual loan amount was like 363. I think that's what it was. 6.1. I got it pretty high, and that was like 3 years ago. Yeah, it was not very good. So when I first moved in, not including, taxes and insurance, this is just principal and interest on the loan. I was paying $2,200. Then I got down to 3.75. I think my new loan at the time I was able to pay down to $350. How much it dropped? It dropped like $500, $600. And then I think it's now at my new loan, because I'm rolling in points, 344, and it's 2.375. $1,300. So now I'm paying for the same home. I'm paying $1,300 when before I was paying $2,200. So it's like a $900 difference just by refinancing every year. And this shows you that in the beginning, it's mostly interest that you're paying, and then the interest gets less and less, because at 6.1 when I had it, look at that. This light blue is interest. All interest. Barely any principal. Barely any. All interest. And then towards the end, so that's how the banks make their money. In the beginning, it's all the interest. You barely own any of the house. And then towards the end, it all drops off. So yeah, another reason why you'd want to refinance is PMI. That's basically mortgage insurance. So you have to pay this insurance, and it's usually until you own 20% of the house. So if you come in with, say, 10% down, and you're paying down, your loan over years and years and years, once you get to 20%, they should automatically do it, I believe. If it's 22%, they should automatically take it off. But sometimes you can refinance to get it off sooner. Another way is if all of a sudden, like my house went up. I came in, I think, 15% down, and then my house went up in value. And so then that's how I was able to get rid of it. So that's pretty much, just going through a refi, kind of like why it's good. And you can see the reasons why I did it. I had to put more money into it to buy down points when I did it. But in the long run, I plan on keeping this for the full 30 years. I have no intention of selling it. I'll probably just rent it out, which I'm, going to probably get a new place towards the end of the year or beginning of next year. And then I'll rent this out. And I got it to the point where now, since my rate got so low, I can actually make money renting this out. Because I have to include insurance and, HOA. My HOA is like super expensive. It is what it is. HOA is basically a homeowners association. They try to keep things nice and, everything looking a certain way. And you also get a pool, a community pool, which I've never used. And this is right there. I can see it from my window, but I've never used it. So yeah, I hope that I would encourage people, if you own a home and you have a higher rate, that you should look into. Just play around with these numbers that I showed you on mortgagecalculator.org and see what works. And you might find that it works. And maybe you're 15 years into your 30-year loan. You're like, well, I don't want to start all over with a 30-year fixed again. Well, you can get a 15-year, a 20-year, a 10-year. And you can get rates super low. I could have got qualified for a 1.5% interest rate on like a 15-year loan. But that would have made my payments higher, which would have screwed me over when I go to buy the next house, because then they look at like, oh, you owe this amount and you can only rent it out for this amount. So now it'll just make it harder for me to qualify for a better loan. So yeah, I hope you like this kind of stuff. I just went through it. This is technically, I've had 3 loans on this house in 3 years. Got my original one, then I refied, then I just refied again. And what these companies will do is they usually get someone and they sell their loan to someone else. So I'm always switching banks because they're always selling the loan. But yeah, have a good weekend. And if you like this kind of stuff, please consider subscribing. If you've already subscribed, thank you. Leave a comment below. Maybe tell me different refis that you've had. Or I always like hearing like older people that bought like homes like a long time ago, like in the 80s or something like that. They're like, oh yeah, I remember I got my home for X price, and then it was like my interest rate was like 20%. It's fun to hear those stories. So if you have some of those stories, put them down below. And thank you.